Today, we are dealing with IAS 16, specifically the headache known as initial recognition. The accountants want you to believe that buying a machine is not just buying a machine. Oh no, that would be too simple for the sadists at IASB. You see the invoice. It says 1 million. Any normal human being would say, great, debit asset, credit cash, 1 million. Done. Let's go to lunch. But no, the accounting department descends like vultures. What about the shipping? What about the installation fee? What about the architect? What about the coffee the engineer drank while staring at it? They want to capitalize everything into the cost of the asset. It feels like legalized hoarding. They want to turn a simple purchase into a forensic investigation just so the balance sheet looks slightly fatter. It's tedious, it's pedantic, and it makes you want to jump out of the boardroom window. Imagine you buy a dilapidated mansion in the countryside because you are having a midlife crisis and you want to reconnect with nature. The listing price is $500,000. That is your purchase price. But you cannot sleep there yet because the roof is missing and there are raccoons living in the master bedroom. So you pay a lawyer to make sure the title is not cursed, a contractor to evict the raccoons and fix the roof, a moving company to drag your mahogany desk up the stairs, and architect to tell you where to put the toilet. Now, here's the kicker. Once the house is habitable, the roof is on, the raccoons are gone, and the toilet works, you decide to throw a massive housewarming party. You buy champagne, you hire a DJ, and you invite all your friends to show off. Here is the rule. Everything you spent to get the raccoons out and the roof on, that is part of the cost of the house. That adds to your asset's value. The housewarming party? That is just you burning money. That is an expense. You cannot tell the bank your house is worth more because you bought expensive champagne for your friends. The Ivory Tower folks who wrote IAS 16 actually got this one right, even if their prose is drier than a martini in the Sahara. The rule for initial recognition is simple. You capitalize every single penny required to bring the asset to the location and condition necessary for it to be capable of operating. That includes purchase price, directly attributable costs, and dismantling costs. Crucially, you must stop capitalizing the moment the asset is ready for use. This is where people get fired. Why does this rule exist? To stop delusional CEOs from hiding their expenses. If I could capitalize staff training into the value of my factory, I would never report a loss. I would just say, we are not losing money. We are investing in the asset. The rule forces us to admit when we are just spending cash versus building value. When you are looking at an exam question or a real-life invoice, ask yourself one question. Could the machine work without this expense? If the answer is no, capitalize it. If the answer is yes, expense it immediately. The cutoff point is sharp. Once the asset is capable of running, the capitalization party is over. Do not try to sneak the housewarming party onto the balance sheet, or the auditors will tear you apart. Now, get back to work. Those assets are not going to depreciate themselves.